Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, March 18th, 2024. Hope everyone had a wonderful weekend. As always, we'll start with our executive summary from today's lead off morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So we'll start with today's key macro event, which is a central bank surprise risk is rising globally. So the nuance there is that investors are due for a central banking bonanza this week with monetary authorities in Australia, Japan, US, China, Brazil, Indonesia, UK, Switzerland, Taiwan, Norway, and Mexico all providing policy updates. Whether the FOMC revises its 2024 and 2025 median policy rate forecast higher in the dot plot is the key decision of this week, followed by the BOJ's decision to end NERP with its first rate hike since 2007. Japan's largest labor union, Ringo, reported that its members received an average wage increase of 5.3% in its annual negotiations, the largest in 30 years, and well above the 4.1% median forecast among economists surveyed by Bloomberg. In terms of market implications, there is a strong case to be made that the Fed should revise its dot plot in a hawkish manner. Refer to our March 16th around the horn for more details. Fed funds futures currently see three cuts in 2024, so a downward revision to two cuts would represent a hawkish surprise for asset markets. Elsewhere, we believe the BOJ should rip off the NERP band-aid tomorrow, given that CPI ex fresh food, the BOJ's preferred inflation gauge, has been at or above their 2% target for 22 months. Lastly, we've seen calls that the boost in manufacturing and investment growth in China will cause the PBOC to take its foot off the monetary easing gas. We disagree. The PBOC's biggest challenge is a deflating property sector, and the latest data indicate challenges persist. We expect the PBOC to continue front loading monetary stimulus for at least another 2 to 3 months. Transitioning to our 42 macro dashboard, as always, we'll start with the trading range signals from our friends over at Longbow. We got an overbought signal here in crude oil, so be aware of that. We have a quite a oversold signal here in the Russell 2000, so be aware of that. Oversold, overbought signal here in Nasdaq range is pretty tight there, so just be aware of that tightness of that range. And then I think we had several overbought signals here in the 10-year nominal Treasury yield. Had an overbought signal in the 2-year nominal Treasury yield, and then had an overbought signal here in the 10-year tips yield. So just be aware that means that bonds themselves are oversold heading into obviously a very big week of policy rate updates. And then lastly, transitioning to a question from our community before we wrap up. I'll read it. It's about the dot plot. It says, Darius, I realize that you've largely got out of the business of opining on the unknown, but what do you think there's a realistic probability the dot plot shows two cuts rather than three? Unless we get a change in the dots, it seems like the Fed meeting will be a total non-event. So definitely, so just addressing that part, yes, we do think there's a very realistic probability, and they probably should. I mean, if I was running the Fed, I would definitely I would try to coerce my colleagues because then it gets a median dot. So it's not like Jay Powell can tell them what to do, but hopefully I would be coercing my colleagues to revise their policy rate projections higher. In our opinion, from our perspective, it's just very clear that the economy, the policy rate is not particularly tight as policymakers thought it was 3 months ago. And so, in our opinion, they should implement a hawkish dot plot revision to send that message to asset markets so that inflation doesn't really start to run away from its current levels. And then returning to the question, interestingly, the July meeting comes right after the Republican convention and right before the Democratic convention, making July very unlikely for the first cut. The Fed is in a bit of a predicament if they do not start cutting by June. Now, my hunch is no cuts this year, despite what the dot plot may foreshadow, and in fact, a hike in Q4. So that's an interesting forecast from our perspective. I don't think the Republican or Democratic conventions or the political election cycle have anything to do with Fed policy. Jay Powell has confirmed that as much. Just in terms of our own review of Fed policy, the history of Fed policy in and around elections, going all the way back to the 70s. The elections don't mean anything to the Fed. So if you're concerned about that or anchoring on that as an investor, you are being sucked into a very narrative driven kind of thought process there, in our opinion, which is not going to lead to better results for your portfolio. So I would advise against doing that and just really focus on the things that the Fed is really focused on. Obviously, the tightness in the labor market, trends in inflation data, the leading indicators of inflation. We talked about that in great detail, all those things in great detail in our most recent Around the Horn. So definitely check that out for more details there. So in terms of Fed cuts, or in terms of Fed policy rate cuts, we don't think they have to get going by a particular month. We think that by the end of the year, however, it'll be pretty clear that the economy is likely mired in sticky inflation as opposed to immaculate disinflation, which means that their likelihood that they cut in 2025 and into 2026 is likely to be that probability is likely to decline pretty significantly by the end of the year. So, in our opinion, it's not about the election; it's about when does inflation bottom and start to reaccelerate again. And our models have that occurring, late Q3, early Q4. So, we'll wrap it up there. Darius Dale presenting our macro minute for Monday, March 18th, 2024. Everyone have a wonderful day out there. Best of luck out there this week, and we will catch you back here tomorrow. Cheers.